What if you could get, a fast track to understanding a complex financial report? Not just the raw numbers, but the real story behind them.
Yeah, the strategy, the market forces, what it all actually means.
Exactly. That's our mission today. We're diving deep into the latest results for Brookfield India Real Estate Trust, the REIT, for their Q1 FY26. That's the quarter ended June 30th, 2025.
And we're aiming to pull out the key insights, the real nuggets of knowledge from their official filings, press releases, investor updates, all of it.
Right. This isn't just about reading out figures. We want to understand what's driving their performance, the strategic moves they're making, and maybe what it tells us about the wider Indian real estate scene.
And just to be clear, everything we discuss comes straight from their official documents filings with the BSE and NSE, their investor presentation, the latest press release, proper sources.
So whether you're tracking the Indian market, curious about REITs as like an investment class, or you just enjoy unpacking how businesses tick, this deep dive should give you a clear, concise, and hopefully engaging overview. You should walk away feeling pretty well informed. Okay, let's jump in. The big picture first. What were the sort of headline numbers for Brookfield India REIT in Q1? What jumps out?
Well, the overall picture looks pretty strong. Their income from operating lease rentals, OLR they call it, saw a nice 9% year-over-year growth. It hit ours, 4,583 million.
Okay, 9% growth in rental income. Solid.
But what's perhaps more interesting is the net operating income, the NOI. That's basically the OLR minus the property operating expenses. That jumped even more, 13% year over year, reaching RAs in 4,986 million.
13%. So NOI grew faster than the rental income itself.
Exactly, which suggests, good cost management or operational efficiency. More of that rent is dropping to the bottom line. They said this was mainly down to new leasing, those contractual rent bumps, and also higher CAM revenue because occupancy went up.
Makes sense.
Now, you might see an adjusted NOI figure, which was RS 4,986 million, actually a bit lower than the RS 4,748 million in Q1 last year. But that's not a worry. It's because some temporary income support on one of their assets, G1, expired as planned.
Ah, okay. So that support was like training wheels, and now the asset's running on its own.
Pretty much, yeah. Its
Okay.
expiry is actually a sign the asset is, well, self-sufficient now.
Got it. That's a good start, especially that NOI growth. Now, what about distributions? For REIT investors, that's often the key metric, right?
Absolutely critical. And here they declared a really robust distribution RS 5.25 per unit for the quarter that totals about RS 3,190 million.
And how does that compare?
It's a big jump, a 17% increase year over year compared to Q1 FY25. Really substantial.
17%. Wow. How does that RS 5.25 break down? Is it all dividend?
Not quite. And this is typical for REITs for tax efficiency. So RS 1.89 was interest payment on shareholder loans. RS 2.71 was repayment of those loans. RS 4.63 was actual dividend. And a tiny bit, RS 0.02 from interest on deposits.
Right, structured to pass through as much cash as possible.
Exactly. Maximize the return to the unit holder. And for anyone holding units, the key dates are record date Wednesday, August 6th, 2025. And the payment should be on or before Wednesday, August 13th.
Okay, good to know. So solid financials, strong distribution growth. What about the operational side? Leasing activity, occupancy?
Operationally, yeah, they hit some good numbers too. Gross leasing was 651,000 square feet for the quarter. That's a decent volume.
And the rents on those leases?
They reported a healthy releasing spread of 22%. That means on the spaces that were relet, they got rents 22% higher than the previous ones. Shows good pricing power.
That's strong.
And crucially, the overall committed occupancy across the portfolio climbed up to 89%.
Okay, 89% occupancy. That feels like where the real story is maybe unfolding. Let's dig into that leasing success and the rising occupancy. What's actually driving this momentum?
It really seems to be a case of having high-quality spaces in a market with pretty robust demand. So the 651,000 skewed of leasing, the vast majority, almost 600,000 skewed did, was actually new leases. Only 57,000 skewed were renewals.
Interesting. Mostly new tenants coming in.
Yeah. And the average rent on all that was RS 100 per square foot per month. The average lease term was 6.5 years. Interestingly, the new leases averaged 6.4 years, but the renewals locked in tenants for an average of 11 years.
11 years on renewals? That suggests tenants are happy to stay put.
It really does. Shows stickiness. And a huge driver here continues to be Global Capability Centers, GCCs. They accounted for like 61% of all the leasing in the quarter.
61%. Who are some of the big names?
We saw major deals like Light taking almost 200,000 SKU TELUS with 125,000 other skeet, and Cognizant renewing for 74,000 skeet. These are significant commitments.
Absolutely. And these GCCs, they're seen as pretty stable long-term tenants, aren't they?
Incredibly stable. They're setting up strategic hubs, not just temporary offices. So landing them means really predictable, durable income for the REIT. It's a cornerstone of their strength.
And this focus on quality is showing up in the overall occupancy trend.
Definitely. It's been a consistent climb. Occupancy was around 80% back in December 2023, and now it's hit 89% by June 2025. That's a steady rise over 18 months.
What's fueling that broader rise?
It seems to be a mix of factors. Strong return-to-office trends are still playing out. You've got increased hiring in tech and by these GCCs, and maybe a slightly improving interest rate outlook help sentiment.
Okay. And you mentioned SEZs earlier, special economic zones.
Right. Recent policy reforms there have really helped. They've managed to lease about 4.6 million SOP8 across different bits of their properties because of these reforms, SEZ areas, non-processing bits, IT spaces, and it's had a huge impact specifically on their SEZ properties. Occupancy there jumped from 69% in December 23 to 84% by June 25.
Wow, that's a massive leap in just 18 months for the SEZ part.
It really is. Shows those reforms are working for landlords like Brookfield.
And looking ahead, how secure is their income stream from existing tenants? What's the lease expiry situation like?
It looks pretty well managed. They have what they call a well-staggered lease expiry profile. Only 35% of their current contracted rent is due to expire between now and the end of FY29.
So nearly two-thirds is locked in beyond the next 4 years or so.
Exactly. Provides a lot of visibility and stability. Plus, they reported a mark-to-market, or MTM, spread of 12% this quarter.
Mark to market. What does that signify?
It basically means if they had to release all the space expiring today at current market rates, they could potentially get rents that are 12% higher on average than what the outgoing tenants were paying. So it suggests there's still upside potential even within the existing portfolio as leases roll over.
Okay, so strong leasing, occupancy climbing steadily, rents potentially heading higher. What does this picture mean for someone, tracking the Indian real estate market or maybe considering REITs?
Well, it paints a picture of really resilient income streams for Brookfield India REIT and significant potential for organic growth just from filling up remaining space and capturing those higher market rents. It signals that demand for good quality office space in these key Indian cities remains pretty robust and sustainable.
Right. It's not just about good performance now, but also positioning for the future.
Absolutely. And that leads nicely into their financial strength and strategy because they're not just sitting back. They seem to be actively strengthening the balance sheet and gearing up for more growth.
How so? What are the indicators of financial strength?
Well, first off, they have dual AAA credit ratings from both IHRA and CRISIL. That's top tier in India, signifies very high financial stability.
That's a strong foundation.
Definitely. And their loan-to-value, or LTV ratio, is very low, just 25% if you exclude shareholder instruments. Even on a consolidated basis, including some other liabilities, it's still only 28.2%. That's quite conservative.
So relatively low debt compared to the value of their properties?
Precisely. And how that debt is structured is also quite smart right now. About 88% of their loans are linked to the repo rate.
Which
means as the central bank potentially cuts interest rates, their borrowing costs should come down fairly directly. They mentioned they've already seen about a 35 basis point, that's 0.35% reduction in their average interest cost.
Okay.
And they expect another roughly 55 basis points or 0.55% of recent rate cuts to flow through in the next quarter, Q2. So they're really well positioned if we are heading into a lower interest rate environment.
That's clever positioning. What about when the debt needs to be repaid? Any big crunch points coming up?
Doesn't look like it. They highlighted a well-staggered debt maturity profile too. The average maturity for the debt on their main assets is 14 years, and for the whole portfolio combined, it's 10 years. That pushes out any major refinancing risk quite far into the future.
Okay, so a very solid financial base. Are they looking to leverage that strength to raise more capital?
They are. The board just approved raising more money through a preferential issue. They're aiming to issue up to about 32 million new units at euro 310 per unit.
Okay, and how much would that raise?
That works out to ours 10 billion, which is roughly $120 million USD. Quite a significant amount.
And the purpose for this raise?
Explicitly stated, to create capacity for future growth opportunities. They're clearly stocking up their war chest.
And who's buying these new units?
Interestingly, they highlighted a diverse mix of 47 investors, came in corporate treasuries, family offices, high net worth individuals. They see that broad interest as, quote, a testament of our high-quality portfolio and positive business outlook.
Yeah, getting that kind of diverse buy-in is definitely a vote of confidence.
It is. And remember, they also raised Rs 35 billion back in December 2024. So this new Rs 10 billion adds significantly to their firepower for potentially large acquisitions or development projects.
Right. Is this new issue a done deal?
It needs unitholder approval first. They've scheduled an extraordinary meeting for Tuesday, August 26, 2025, for that vote.
Okay. Anything else on the financial side? You sometimes see complex related party dealings with REITs.
They do detail various related party transactions in the filings, things like unsecured loans given and repaid between group entities, interest income from subsidiaries, management fees paid to the investment manager. It's all laid out.
Which is important for transparency.
Absolutely.
Mm.
While these transactions are common in REIT structures, disclosing them clearly like this actually builds confidence. It shows everything's, above board and accounted for.
Okay, so connecting all these dots, strong performance, solid financials, fresh capital, what does this signal about their sort of strategic direction and long-term vision? It sounds like they're shifting gears from just stabilizing to active expansion.
I think that's exactly right. They're looking beyond just good performance now. They seem to be setting some pretty aggressive growth targets.
Such as?
Management stated they expect to push that committed occupancy up to over 95%.
95%. That's pretty much full.
It is ambitious, and they project that achieving this will drive about 13% growth in NOI and, get this, roughly 22% growth in distributions compared to the current quarter's run rate.
22% potential uplift in distributions. That's huge.
It is. And looking a bit further out, they're guiding towards a consistent ongoing growth trend of 5% plus per year for NOI and 6.5% plus per year for their net distributable cash flows per unit.
Those are definitely growth numbers, not just stability numbers. How are they planning to achieve that? Acquisitions must be part of the plan, right?
For sure. They mentioned they're in active talks with their sponsor group, that's the wider Brookfield Asset Management Group, about potentially acquiring some really prime grade A properties.
Whereabouts?
They specifically named assets in key cities. In Bangalore, there's EcoWorld, which is massive. It's 7.5 million square feet, and also EcoSpace at 1.6 million. And in Chennai, the Millennia property, also 1.6 million square feet. These are major established assets.
That's a significant pipeline just from the sponsor. Any other opportunities mentioned?
Yeah, there's an interesting situation with Equinox Business Parks. Brookfield India REIT has a right of first offer, or ROFO, on it. Apparently, the current owners are talking to third parties right now.
So they might lose out.
Possibly, but the filing says if those third-party sales don't happen within the agreed timelines, then Brookfield India REIT gets a fresh offer. So that door isn't necessarily closed. It remains another potential large-scale opportunity for them.
Okay. It really sounds like they're leveraging their position. How do they actually stand in the broader Indian office market right now?
They hold a pretty unique position, actually. They emphasize being India's only 100% institutionally managed office REITs.
What does that mean in practice?
It means their management structure is fully aligned with institutional standards, often seen as providing better governance and professional oversight compared to, say, family-run or developer-backed platforms. Their portfolio itself is substantial. 10 grade A assets, totaling 24.5 million square feet already operating.
And these are in the main cities.
Yes, strategically located in the big gateway markets, Delhi NCR, so Delhi, Gurugram, Noida, Mumbai, Kolkata. And if you include the space they have for future development, their total potential leasable area is actually 29 million square feet. They're a major player.
And having Brookfield, the global giant, as their sponsor must help.
Immensely. Brookfield Asset Management is one of the world's largest alternative asset managers, over $1 trillion in assets under management. That provides huge financial backing, global expertise, and strategic insight.
A big advantage.
And crucially, their sponsor group owns another 26 million square feet of office assets in India that are not currently in the REIT. That represents a massive potential future pipeline just within the family, so to speak.
Wow. Okay, so growth potential seems baked in. We've talked numbers, strategy, growth. What about the softer side, things like sustainability, ESG? Is that on their radar?
Very much so, it seems. They position themselves as leaders in sustainable office development. They highlighted properties getting certifications like EDGE. That stands for Excellence in Design for Greater Efficiencies, and also renewing ISO 50071 energy management certifications.
Any specific examples?
Yeah, they mentioned winning a Platinum Award for Best Kaizen in Sustainability for their downtown Powai property, and their Airtel Center building got platinum awards for both safety and energy and utilities.
So getting external recognition for their efforts.
Exactly. And they also mentioned tangible initiatives like planting 4,600 trees across the Delhi NCR region and organizing wellness programs for employees and local communities. It suggests a more holistic approach, looking beyond just the financial returns.
Okay, so pulling this all together then, we've covered a lot, the financials, the leasing, the strategy, the potential. What's the main takeaway from this deep dive into Brookfield India REIT's Q1?
I think the clearest picture is one of really strong momentum. Robust leasing, driving occupancy up, solid financial footing being strengthened further by strategic capital raising, and a clear path outlined for future growth, both organically and through potential large acquisitions.
Yeah, it feels like a company firing on, well, most cylinders. Strong performance now and actively building for the future.
Exactly. They seem very well positioned within the Indian office market, especially that premium grade A segment. The combination of operational strength, financial prudence, sponsor backing, and now this added focus on sustainability.
Hmm.
It paints a compelling picture.
So, as India's economy continues to grow and that demand for high quality, maybe more sustainable office space stays strong, this deep dive really shows how a well run REIT can potentially deliver not just those consistent distributions investors look for, but also build real long term value.
Right, through smart acquisitions development and that commitment to ESG principles.
Which leads to a final thought, maybe for you, the listener, to ponder. Given this blend, we're seeing traditional, strong asset management combined with these modern ESG initiatives. How might this kind of approach start to influence broader investment strategies, particularly in emerging markets like India? And what other innovations could we see coming down the track in real estate to meet what seem to be constantly evolving demands from both tenants and investors? Something to think about.